Hi, I'm Steve Van Metre. Welcome to your weekly economic update, where we go through the broad look of economic indicators, my thoughts on what's been going on over the last week or two, and where we take a deep dive into the charts to see if we can find some opportunities in this market when we're really in a bear market. So I want to start out by talking about, are we back in a bull market? Because all of a sudden, everyone's stock euphoric again, pile back in after, well, just 2 weeks ago, the world was coming to an end. So let's kind of back up a little bit and assess the issues that have been going on and see what's up. Hey, Karen, I don't know if Steve's with you. Kim, thanks for joining us. Glad you could be here today. So anyways, let's back up 2 weeks ago to when Treasury Secretary Steven Van Metre was calling the banks and calling the Fed and the FDIC and making sure we had enough money to pay our bills. And then after Christmas, everyone said, oh, everything's okay again. So starting out, let's go with the government shutdown. Now, on the beginning of this, you have to understand President Trump's proxy for what you and I think, the public thinks of him, is based on the stock market. So if the stock market is rising, then he thinks what he's doing is fine. And if it's falling, well, then he doesn't. So the first thing is, we are in a shutdown still. There's no clue to when this is going to end, and the stock market's rising. So, of course, he's getting some validation. Now, the question is this a problem? Yeah, it's a gigantic problem because, the first couple of weeks of a shutdown, all right, not a major economic impact. But as a shutdown persists, the risks to the economy grow exponentially. And if the shutdown persists for a while, and Susan, thanks for joining us. If the shutdown persists going into, say, another month, we could be in a recession in March. And you can go, oh man, that's going to be really bad for Trump. No, actually, I don't think it is. And this is where I think this gets pretty interesting. So what does he want? He wants a wall to the tune of, say, $5 billion. Well, in a country that's running $1 trillion deficit this year, $5 billion really is nothing. So in the end of the day, he's not asking for much, but he's going to try to break the House Democrats. And all he has to do is sit back and do nothing, which is pretty much what he's doing, and saying, come to the White House and, we'll accomplish nothing until you agree to give me my wall. And there's something kind of smart about this because he's playing with all the cards. If the Democrats don't capitulate, well, then we stay in shutdown, we have a recession, and who's he going to blame? The Democrats. See, the public's going to point their fingers at him, and he's going to say, I just asked for $5 in the grand scheme of, say, $10,000 to spending, and I didn't get it. It's their fault we're in a recession. And this can play to his favor in two interesting ways, because Trump wants, sorry, I should say President Trump, just bad habit because I've watched him on TV for so many years. President Trump probably knows that we're going to have a recession at some point. And what does he want? He wants the Fed to stop. Well, how do you get the Fed to stop? Have a recession. And how do you get a recession? Keep the government shut down for, 2 months or so. That'll work. And then what can you do? Save the economy by getting the Fed to back off, maybe getting some sort of stimulus program out there, and he can turn around. Because the longer he waits in his presidency, and I said this 2 years ago, the longer it gets into his presidency, the bigger the risk he faces of not being able to recover from a recession. And behind closed doors, apparently he has commented that I don't want to be the sitting president of the next Great Depression. So people are obviously educating him on what the real risks are. And so this is kind of an interesting play on his behalf because he could win either way. A lot of people don't view it that way. So nothing's changed there, except the longer this trade war persists, the greater the risk to the economy. Now, let's move to the next thing. China. Oh, gosh. Lots of misinformation and fake news. So what did we get on Thursday? We got fake news saying that suddenly the Trump administration wants to back off on their tariffs to China. Sorry, not happening. In fact, we've got China right where he wants them. Their economy is rapidly slowing down. Now, of course, ours will too. But remember, we are lagged in the global economy. We are behind everybody. So as you see China slow down because they're an exporting nation, it takes a while before the importing nation comes back. So we're winning essentially a trade war that's not because of the tariffs. Want to know why we're winning? Because the Fed's tightening the dollar money supply around the world. And when you are an exporting nation and there's not as many dollars around, the economy contracts. So oddly, President Trump doesn't want the Fed to continue tightening, but they're actually helping him. So immediately later, or shortly after this meeting at the White House, the people came out and said that report is totally false. We never said those things, and the stock market still went up. There's phase two of this is China dumped $1.16 trillion of currency into their economy this week. Put that in perspective, it took 12 months for corporations to buy $1 trillion of their stock back, and they dumped $1 trillion in their economy in 1 week. So it tells you they're getting pretty desperate. But here's where I think it gets even more interesting. I don't think people really understand this trade war is not about trade. It never was about trade. We are effectively having a Cold War with China. Bet you didn't think of it that way. It's a Cold War with China. Because what do we want? We want to break their government. That's, bar none, what we want to achieve. Now, how do you achieve it? Well, you could go to war with them, shoot them. Now, that's one way to do it, but that's probably not in our best interest. So what's the second best way? We have an economic war in a country that has a huge population and they need to employ. That's communist, because when that population gets really upset, they'll overthrow the government. We won't have to do a thing. So the notion that we're going to back out of this anytime soon, I don't see that happening either. And so some more fake news came out today that said that two unnamed sources, very key, two unnamed sources out of China who wanted to remain private, said that China was prepared to offer to buy $1 trillion of U.S. goods over the next 6 years. Now, I'll tell you why that's fake. First of all, import and export growth from China is falling. So I don't know, one, where they're going to get the $1 trillion of stuff to buy from us, but they don't have the demand. Number two, and probably the more important one here, is if you divide 1 trillion by 6, you find out that the amount of stuff that these two parties claim that they want to import is more than we have to export. So I don't know what they're going to buy, but we don't even have enough stuff for them to buy. Fake news, nothing going to end there. So again, two things haven't changed in the last 2 weeks except the public buying stock. Number three, and I'll tip my hat to Fed Chair Jerome Powell, because he totally bamboozled everybody. All these people 2 weeks ago were crying, "Oh, Fed, please stop hiking. This is terrible. We can't handle it anymore. Look, you're killing the economy." And he said, "Fine. If the conditions warranted, I will." And everyone's like, "Oh, you're going to stop hiking. Awesome. Buy stocks again." And guess what? He didn't do anything. He didn't change. You'll see the federal balance sheet is still declining. He didn't do anything. All he did was placate investors. So in a sense, the last 2 weeks, nothing's changed except people have perceived the stock market as cheap. And these are the people who wanted to buy perhaps a year or two ago, but were too nervous because it was just going up too much. And now they think, this is my last opportunity to buy in. And boy, they are wrong, because nothing has changed. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This material is not to be construed as recommendation or solicitation by or selling a security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. The opinions expressed in the video that I'm on do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. All right, so I've got some charts for you, and I'm going to go pull them up now. I think because of the government shutdown, all the data is not there. So I don't have some of the charts that we're used to looking at, I don't have. So anyways, let's take a look at what I got for you. All right, the first thing off is the M2 money supply has now slowed down slightly to 4.9% after this big jump. And I was trying to figure out what this was from, and I couldn't, I just didn't have an answer. I was looking at the consumer credit data, I was looking at the commercial industrial lending data, and nothing really matched up until I read a report from Dr. Lacey Hunt, probably the foremost expert on the money supply in this country. And he said the jump in the money supply had to do with the fact that in December, people started panicking, selling their stocks, and they put it in cash, and it showed up in the money supply report. Aha, makes perfect sense. So we should see that dramatically reduced in the weeks that come. So looking at the the data. The 6-month rate of change is starting to roll over. The 3-month rate of change took a hard reversal, is now falling as well. And so we should expect to see this drop. And in fact, I don't think I didn't update this. That was my mistake. I meant to, but sometimes that happens. So looking at the Federal Reserve balance sheet, so this is where everyone was worried. Fed needs to stop, and Fed didn't. They rolled off $6 billion last week. I believe they're going to dump off about 21. I believe they did dump 21 billion this week. We'll see where it shows up in the hard data because it's always a week behind. So here you can see from pretty much the end of the year where he said, "Don't worry, I got you back." Yeah, he totally lied. I love it. He bamboozled all the investors. Because if you watch this press release, granted a lot of people don't do that, but I watch him. Sometimes I watch him a second time because I often miss things if I'm at work. And he pretty much said that the stock market is just really overly emotional because he didn't see anything wrong with the data. And all he did was say just enough to get people to go back and buy stocks. Awesome. Absolutely incredible. Looking at the global M1 money supply. And what we see is it is decelerating and heading into a contraction zone here. It is not doing well, and industrial production tends to lag, but it follows it. Now, we're not seeing that in the U.S. yet, but we will in the next couple of months. But we're definitely seeing global industrial production tank. Going on to the regional Fed surveys, as you know, for 2 years, I've been saying interest rates are headed lower, and you can see the regional Fed surveys are all these colored lines and dotted lines all over the place from the different regional Feds, and then you've got the 10-year Treasury yields on a year-over-year basis, so that tells us that they should be headed lower, and they're right. Going on to stock market leverage, everyone thinks, again, this is a fantastic buying opportunity. You want to find a generational low, wait till all the speculative money has been wiped out. And you can see leverage in terms of borrowed money and leverage ETFs and speculative future positioning is at an all-time high. Well, aside from the peak here, it's pretty much an all-time high. And until it gets wiped out after, say, the dot-com bubble, and it really got wiped out hard during the great financial crisis, that's where your generational buy is. Not here, it's way down here, and that will happen. Looking at the market, which we've seen juiced by the Bank of Japan and European Central Bank, came to the rescue. It wasn't the Fed, it was those two central banks that quietly dumped liquidity in the markets at the end of December. And they pushed stock market higher while the U.S. macro surprise data, the surprise data is when an analyst says, I think this is going to happen, and they're wrong to the downside. And forward earnings per share projections are headed lower. It tells us the stock market, is way out of line. And this kind of a repeat. When I put this in, I forgot I had the other M1 chart, but this is pretty cool. Morgan Stanley put this out. Global M1 growth bottoms at the end of March. And what they're saying is that in every time the global M1 contracts, which is going to predicted to contract by the end of March, you have some sort of financial crisis. You can go, not always, but early in, you see these are recessions here in these gray bars. So right after recessions is not a big deal. But anytime after that, it's a problem. And what they're predicting is something's going to happen. Whatever it is, it's coming. And we'll see how central banks react. Looking at quantitative tightening, as I've been talking about, the Fed's tightening, and soon the Bank of Japan, who someone put, why is Bank of Japan, who has been pumping money for the last 20 years or 30 years, 30 years, why are they tightening? Someone's answer was, they ran out of stuff to buy. Okay. So Bank of Japan's going to stop easing. European Central Bank is going to stop easing, and we're going to max tightening. And this is what's coming: is global central bank liquidity, which has been propping up the global economy and markets, is going to contract is contracting this year, and is going to continue to contract, projected to contract into early this year. Or a good part of this first half of this year. So if you thought the stock market was looking bad in December, wait till it starts digesting all of this quantitative tightening. And so that brings us to our last chart, which is a great chart about the psychology of investing. And so the smart money always comes in early, followed by the institutional money managers, and then you get the public who buys in. So remember up here, back in October, everyone's like, hey, this is it. Everything, valuations don't matter, earnings, nothing matters anymore. It's just stock's going to go up forever. We came back down. Then you get what's called a bull trap, where it brings buyers back in. And isn't that exactly what's happening right now? Nothing has changed except people think stocks are cheap, and now they want to get in on what they missed out on. You never miss when the Fed's tightening. Never. Never, 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 never. Not 3 years into it, exactly. So what happens is, and look where we're right now. Return to normal. Oh, everything's great again. And then what happens? It rolls over and blows apart. And that is kind of what we have to look forward to with the markets. Now, let's pull up a chart of the from the Federal Reserve. I'm dancing around these windows because sometimes I forget how they work, and there it goes. Okay, so now bonds this week backed up in yield. So we're going to go to the Federal Reserve website and look at H.8, page 2, and we'll make this full screen because it's cool that I figured out how to do that. And here you have Treasury and agency securities, mortgage-backed securities, and non-mortgage-backed bonds. From January 2nd to the week ending January 9th, the Fed added, say, about $9 billion in Treasury bonds. They sold off a couple of their $2 billion in mortgage-backed securities, so they dropped that by $2 billion, so we're at $7 billion. And then they added $10 billion, so they added what? $17 billion worth of bonds? Wow. So the biggest player in the bond market, banks, are buying, as speculators and investors are selling bonds as fast as they can. Tells us again, they're going to be wrong, as they always are. I want to look at momentum. We haven't done this in a while. It wasn't for the lack of me updating it. It was just for the lack of me showing it to you. And so let's take a look at momentum, because momentum is predicting some dire things. And so let's look at the S&P 500 going back as far back as the... this is the exchange traded fund symbol SPY. So you can see that in early rallies, when the momentum turns negative under this gray bar, nothing bad happens. But when it turns negative in the late stages of a rally, well, you enter a recession. So here you see it twice. It entered, contracted and entered a recession. Now in 2016, it contracted. We had a quadruple bottom, double bottom here, and it came out of it. Now we're having it again. So you can say 1, 2, 3. So 3 out of 4 times are going to tell you, is this a repeat of 2016? No, not at all. The Fed was not really tightening here. The Fed is massively tightening here. So nothing has changed, except the odds are, momentum is telling us, the odds are that this bounce here is going to come down to the downside, and we're not going to see a double bottom here. We're going to see it continue to slide. If we look at the Dow, we see the same thing. Momentum headed negative, and again, you can go back 3 out of the last 4 times you had a recession. And so that's pretty much an indicator now that this is going to be a recession. If we look at the NASDAQ, has anything changed here? It's heading to contraction. And again, same story. When annual momentum goes negative, bad things happen. So I think that's pretty interesting. All right, so let's get over to some charts. No, I am struggling here. There we go. It's a problem when you have too many windows open and you're trying to figure out which button you need to click, and you keep clicking all the wrong one. All right, so let's take a look at the S&P 500. This is all public buying in here, retail investors getting back in the market, fear of missing out. And they cracked the 50-day moving average on Thursday, rather impressive on fake news of the China trade war coming to an end. And then today, just on more news of trade war impasse, you got a surge of buying. Plus, today was pretty interesting, because what happened today was options expiration day. So a lot of option contracts, which are just pure bets on one direction or the other of the market, expired. And so people that were heavily short, which apparently there were some major short players, got coughed out of their position and they got forced out, which turns them into buyers. And when you have buyers coming in to a market that's already kind of on fire, it pushes it even higher. So we saw that today. If we look at volume, which is a telltale sign of real participation, you can see volume is falling off. And all this is saying is just demand is going away. So when these Cayenne bars go down, it's just telling you demand for stocks are falling. And you got this little bump here, but these little bumps weren't that big for the big price move. So it's just saying that the sellers are just letting the buyers have their day. They're letting them buy into the financial media's news. The bull market's back and it's working. It's pulling all of this retail money in. And when you, I don't want to stick on that chart, but here's the deal of how you know market bottoms happen. These V-shaped bottoms don't happen that often. They are usually confirmed by a second bottom. So you can go over here back to, let's see, 2015. You see a bottom up, bottom confirmed. Second, unusual, but a double bottom with two bottoms on each. So here you go, double bottom again. So the notion that this is just a single bottom and go, highly unlikely. And you say, well, wait a second, Steve, back in 2013, look what happened here, single bottom and go. All right, well, I'll give you two reasons why that wasn't valid. One, it confirmed off this 50-week moving average. Number two, the Fed wasn't tightening. It wasn't tightening. So could we get a run of the S&P all the way back up to its 50-week moving average? Sure. Yeah, anything's possible if enough people want to buy. But the reality is the Fed is tightening and bull markets do not start or continue when the Fed is at maximum tightening. All we did was get a confirmation or a bounce off the 200-week moving average. And this is why you will read, if you go online and read from different traders, they'll all tell you this is going to get massively reversed. They're looking for a double bottom back at the recent low. If it doesn't stick there, prices go further. If it does, now you have double bottom, you have some validity to this rally, but it's going to pull all these buyers right back out. And that's what we should expect to see. And surprisingly, volatility is not really confirming these major moves down. It didn't confirm it on Thursday, did not confirm it today, because volatility should be way down here somewhere, but it's not. And so again, we should see volatility come back up, and stock prices should go down somewhere in here and either try to reconfirm this as a double bottom, or it's going to break lower. Volatility should come back up and reconfirm this as a double top or keep on going. That's what we should see. Now let's take a look at the bond market, because we know the banks are buying while the public is selling. And when the biggest marginal buyer that can buy bonds for no risk buys, should be a really good indication of where you should put your money. And so here we see interest rates going up as people are so excited about stocks, so they're dumping all the bonds they bought in here. And you'll notice they're not getting this big push back up here. So let's go and look at the market. So let's see, the last time I was up here was roughly mid-December. Let's see. So let's see, mid-December is up here. So what this tells us is the bond market is not confirming the move in equities, because yield should be way up here. They're not. So the Fed is, excuse me, the banks are buying bonds and supporting the bond market while the public is selling bonds. And even the 30-year, which yield should be up here, double bounced off of their resistance. So hit resistance, bounced off, hit resistance again today, bounced off again, telling us these people that are shorting the bond market or selling bonds are totally wrong. All right, let's take a look at the gold miners. I love what I'm seeing here. And let's zoom out on the gold miners, because when central bank policy goes wrong and deflation occurs, gold goes off like a rocket. And we're seeing gold came up here to resistance or gold miners. And I thought, nah, it's not going to break through here just yet. Now, why did this down move happen? Because Vanguard unloaded a fund that was heavily in gold and silver mining stocks and converted into something else, and they had to dump those positions. So now we're seeing those positions get absorbed here, and buyers came in, brought it up to resistance, sellers came in, and what we want to see is I doubt it's going to hit support on the 50-day moving average. It might briefly bounce here and head back to the 200-week, but if you'll notice, it tends to track its 100-day moving average in blue a lot tighter. And here's a little support line. Here's one. Here's another one. Now, if it breaks below the 100-day, I'm not as committed on this, but if it holds here, I'm pretty interested. Again, I went over this, I think, Wednesday, but I'll look at it again for those of you who missed. You see it came off a bottom, went over the 100-day, went higher, kind of like now, reconfirmed the 100-day, would trigger a rally, except it got rejected against the 50-day and then went lower. Now, these two are both trending upward. It was trending here, but it was starting to roll over. So this could be a pretty good dynamic if it can get confirmation down here and a lift off past these two moving averages. It's got a lot of possibility there, and we can go backwards in time and we can look at the last major time it crossed through some of these moving averages. There's a bigger gap, but it caught the 50-day on this nice downward moving up, and here we were flat on, the 100-day. The 100-day here was flat. Now we got a down move and a curve up. So what I like to think about the moving average is kind of like a trampoline. It kind of gives a little spring. So prices come down, they hit the moving average, it kind of bends a little and then springs them back up, and then all of a sudden you see a market rally. And if you look at it, markets love moving averages. And I'll show you something a little easy. Here, we'll just look right here on the gold miners. You see it rallied up, confirmed the 50-day, and kept going. Now on something else like the S&P 500, it's a little easier to see how they kind of will rise up, bounce off, here down the 100-day, confirm the 200-day, went up, hit the 50-day, hit the 50-day, hit the 50-day, hit the 100-day. So markets like these moving averages a lot. I mean, they just love them. And so we want to see this trend happening here. We want to see a move. We want to see a rally begin by a crossover and a confirmation. And I think the best place to look is the silver miners, because I think they're the right place to watch. And we're seeing the 100-day flatten, the 50-day roll up. We see the same rejection here at the resistance level, and now we want to see it find support in here. And if it doesn't, it tells us gold is probably not to follow. It's probably not coming. Now let's take a look at the oil and gas producers, which I thought were going to get rejected here, but there's just so much bullish sentiment. They didn't. They crossed over, but the trend is down, and they'll need to somehow reconfirm this, but likely they're headed back down with everything else, looking for a double bottom. Again, we've looked at this before. You can pretty readily see double bottom here, double bottom, and there is a double bottom in there if we zoomed in. So single bottoms don't really count for a whole lot, in my opinion. Let's take a look at what else we got. Oh, let's look at PG&E for fun. PG&E is, as of today, will no longer be part of the S&P 500. That's where all this volume came from. It's now in the hands of the public, who believes that this is the long-term buy. Good luck to them. I don't see that happening, simply because there's a lot to come for PG&E in terms of lawsuits and court cases and who knows what. So I don't see that. I'm guessing this is more like a General Motors, where it will eventually go to zero and be reissued under a new symbol or new something. Let's take a look while we're here at the agricultural commodities. Now these moves were happening out before anything about any trade impasse with China. So I'm feeling okay with them, but again, it finally crossed and closed over its 100-day and 50-day again. So the more times it crosses over, it's going to continue to get attention, and at some point this thing has got a lot of room to run, and you can zoom out over the last 2 years and say it's got all the way back up into here is where it's going to try to get out again. At some point it's going to get all the way back up into here. Let's see, gold is kind of telling us what we already know, that it's going to come down. You see its 100-day is way down here. This is a physical metal, so it could bring the mining stocks down. So it's got some move to come down and reconfirm support here, which was coincidental because the 100-day moving average is coming right into the support zone. So that'd be really cool if gold came down and hit and tagged both of them. And that would be pretty nice confirmation. You can see it likes its 100-day moving average a little bit more than it likes its 50-day here in this green line here. It doesn't quite as correlated as with the 100-day. So I like those as well. Let's take a look at the 7 to 10 year Treasury bonds. So there's a little bit of reversal here, not much. Volume's not too strong, so the short sellers are not very strong in this move down. You can see there's just not a lot of volume, not a lot of shares traded, and they're holding right into here. Now I'll zoom back out, and you can see there's a soft support line right into here. It held that today. This is a really good sign for the bond market. It just needs to get some lift off above this resistance zone here. Once it gets up here, it's got a lot of room to run and get going. And same with the long bond. I know this is where the short sellers have been really focusing their efforts, but for all of their efforts, it's coming right down to the soft level of support here, and then it can turn around and go. In fact, we can almost just take out these two lines here just to get them out of your view, and you can see there's just a little bit of support here, and if this can get some lift off as well, as long as the banks are buying, well, you know all that you need to know. Oh, you know what? I just realized that you could not see any of those charts, and I'm going to guess that somebody is going to say something about that. So, once again, I don't know how long I spent on these, but I apologize. So I'll go back and let's do them again because, hey, why not? So where were we? With the gold mining stocks, real quick, we see reversal here at the resistance zone. Man, I hate it when it kind of irritates me when that happens, but there you go for technology. Here hits resistance, coming down to confirm its moving averages. We'll zoom out and I'll show you again so you can actually see it. Here's a major bottom in the gold miners. It crossed over 2 moving averages and took off and then found support along the way. And again, to reiterate why markets like moving averages, you can see once they break out to a bull trend, it kind of follows this. You see the S&P 500 hitting the 50-day, 100-day, 200-day, and then climbs up 50, 50, 50, 100, and it just follows the moving average pretty much up. So markets really like that a lot. Looking back at volatility, you can see volatility did not go all the way down as it should have. It kind of is not following this market move higher. So market participants are not buying into that. The 10-year Treasury yield should be way up here. It's not. It's hit today this resistance level and rejected. The 30-year hit resistance twice and rejected. It should be up here going back to matching where the market is, and it's not. Silver has given us a much better view of this because it's got to come down and hit its 100 or 50-day moving average and pop from there. So if silver breaks through here, then we're not quite there yet. If it holds in this area, this is a really good sign. Gold, on the other hand, it's got a long ways down to its 50-day and 100-day here, and we, as I mentioned, it follows its 100-day a whole lot better. You can see it just kind of tracks along this blue line a lot better than it does this 50-day average here. Back to the ags again. It's crossed over its 50 and 100-day here. It just needs to get back over the $17 price point, and then it's got all kinds of room to get right back up here and go. PG&E, as I mentioned, it's out of the S&P 500 as of today. Lots of volume here now in the full hands of the public. Bond market. Let's see. 1 year came down into here. 7 to 10-year Treasury bonds, not a big move. Look at the volume here. Not a lot of short sellers here. Found the soft level of support right back into here, and it held it. If we go back over a 2-year chart, and you can see there right where my mouse is kind of going across, soft level of support here to reconfirming. It's got nothing but room to run once it breaks out of this resistance level. Same with the long bond. Short sellers have been focusing their efforts here, and it found some support right down into here. It needs to get out of this level of resistance, and it's got some room to go. So apologize for you watching me talk about the charts there for so long. That wasn't... Oh, you did see most of them. Well, I'll go over them again. Dustin, thanks for joining us. Appreciate having you on here. So that's our update for the week. Now, there will not be an update on Monday because the markets are closed for Martin Luther King Day. Now, foreign markets will be open. I'll be watching those. I'll probably be here doing something anyways. But just so you know, we'll be Tuesday night. We have a repeat of the tax list. It will be live, and then we'll be back Wednesday night for a midweek update. So again, apologize for whatever you missed, and if there's something you really want, I'll probably cover it again Wednesday, so don't worry about that. So I'm Steve Van Metre. Thanks for joining me, and I hope to see you on a future live next week. Bye now.